everybody, welcome back to another episode of Bullish or Bearish. I'm Angela Chu from Success Options Group, and I'm actually here with my brother Tony. Now, what we're doing is we're going to talk about a topic that's very interesting in the financial area, and we're going to have you understand like multiple sides, like both sides of the stories, so that you can actually get a better idea of what's exactly going on, and you can make a good decision.
Yeah, I mean, like we've hit upon a bunch of a variety of topics, right? The last one was prescription drugs and generics, right? So, I mean, make sure you check out some of the prior videos. And of course, you know, obligatory like, subscribe, comment, right? But let's move on to what today's topic is going to be. And today's topic is volatility and why volatility is good for your investment portfolio, right? So, I mean, for those of you unsure what volatility, the measure you usually hear is the VIX, and the VIX is tied to the SPY index, right? So the S&P 500, and volatility, or the VIX, as we'll use probably in this session, is about the fear index. That's what people will call it. That's the buzzword, the fear index. So as things get scarier or get as the S&P goes down, the VIX will go up, right? So historically, it's been about a 4-to-1 ratio. So if the S&P, the SPY goes down 1%, the VIX goes up 4%. And this could be all sorts of events. It can be a war occurring, right? Or a sudden outbreak of COVID, right? And this will cause, and you guys know this, like you'll cause the stock market to tank. So I will let Angela speak a little bit on this now.
So he's talking about the great uses of volatility. The problem is volatility is exactly what it sounds like. It means that things are uncertain, that things are risky, things are volatile. Now, okay, when you're thinking about something that you want to invest in long term, like, do you really want to invest in something long term that's risky? You know, there's no guarantee, because volatile means exactly what that word is. That means it's uncertain, that it could go up, but it could also very much go down. That's why, like, when you're talking about long-term investing, don't you want something that's more stable, secure, that you know what's going to happen?
So this is where I'm going to say volatility is good, because it lets you get into these investments that you're wanting to, right? So, I mean, we've talked about this before in our video on whether it's a dip or it's a knife, right? And that's the question, right? Is like, well, when is the low? When are you hitting the low? Because, if you've done your fundamental analysis, right, and you figured out what investments you're interested in and maintaining long-term, as Angela is talking about, well, these are your times where you're going to be able to get in at your discounted rates, right? So there will be drops, and if you're confident in your investment, in your thesis, you're going to be able to get these things at a discount, and you're going to be able to add to your positions, or you're going to be able to get into new positions on things that you're wanting. Okay,
so that use of it might be true, but that also requires people to actually know what they're doing. You have to have the education and the knowledge to be able to, in a sense, take advantage of these points. But the problem is most people think that volatility is you could use it for any stock. And the problem with that is volatility in a stock, in a random stock, means that the stock, price is not actually based upon the actual company's, profile, the company's, like how they're running their company. It's based off of like other things that are controlling the price, not the company itself. So that means that it's, yes, some political or other like kind of things might be happening that might affect it, but it could also mean that they're actually being controlled by large investors. And you never know when a large investor will suddenly wake up in the morning and decide that, oh, they don't want this stock anymore, and like sell off, and suddenly your stock suddenly tanks for no reason, and you don't know why. So you have to be able to differentiate between, the ones that are volatile for what reason.
Right. And now this is where technical analysis comes into play, right? So the nice things about volatility is now when we talk about options, one of our favorite things is your option prices are better, right? So the value of your contracts increases, because so if you have those skills, if you have that knowledge to sell calls or sell puts, and you got to be careful about when you're selling something. So usually we're talking about covered calls, or we're talking about cash secured puts. But the ability to sell that gets you a larger amount of income, right? So we've talked about this before, where you're using options to help subsidize your income on your stock positions, or you're selling that cash secured put because you want to get into this investment that you say, oh, okay, this is a good time, and I'm going to make a little money on it while I am willing to get in at this price point, right? So this is where volatility is good, because it lets you, the option contracts have more value, so you're able to take advantage of that. Whereas, let me finish this off, whereas when it's all calm and quiet, you don't make as much money.
So while you're saying that, I mean, I totally get what you're trying to get at, but the problem is it's not sustainable. Like, you can't just set it and forget it. You have to actually be keeping an eye on it. And there are people who are busy, who are working all the time, and who don't have the time to like really concentrate and keep looking at their stocks that much. Like, it's not sustainable for them, because volatility means that you have to keep your fingers on the pulse. You can't just set it and forget it. You have to keep paying attention, because volatility also means that you don't know when it's going to change. And that is like something that not all people can take advantage of, because not everybody has the time or the willingness or even the knowledge to be able to do it.
Yeah, I agree. So life is volatile, right? You don't know when a phone call might occur, right? And mess up when you're in a video, right? But it is part of being an investor. So we want to be in the stock market. We want to do things. No investment has no volatility at all, right? So everything has risk. Everything has an amount of risk. So don't let anybody tell you that something is a safe investment. Everything has some measure of risk, right? And so that's why you need to be able to take advantage of volatility. So like even in real estate, when volatility, like when prices are high or prices are low, that's when you can get in a really good deal. And in real estate, like we thought, you make your money when you buy, right? And that's actually pretty true in a lot of investments. You make your money when you buy, right? So if you get a good deal, a screaming good deal, and I love good deals, right? That's when you make your best return on investments.
So really what it boils down to is, like we always say, it's not about what you're doing. It's not about the volatility. It's not about any specific topic. It's actually about, do you have the knowledge to use the information? That's why we always say, like, you need to get the knowledge. You have to let yourself like be educated on like what you want to do, so that you can actually make good decisions for yourself. That's why we give workshops. That's why we have programs. And that's why we like do these videos, is because we want everybody to actually be able to increase their knowledge so they can make good decisions that actually make their own future brighter, make them reach for their goals and be able to do what they want to do. So really, hit the like, hit the subscribe, and come back and see our next video.